Hi, my name is Nils. I'm CEO of HemsöFastighets. HemsöFastighets is a fully integrated property company focused on social infrastructure, which basically means nursing homes, schools, hospitals, healthcare. We own about 5.2 billion euros of assets in Sweden, Finland and Germany. Sweden's biggest with about 3 and about 1 billion each in Germany and Finland.
Great, thank you. Olle.
Yeah, Olle Håkanson, Nobel. I'm, as Richard said, a partner the transaction team in Stockholm. And we started the Stockholm office for about 2 years ago. And Croisette, we're a fairly new player on the advisory scene in Sweden. Been around for about 3.5, 4 years. So 2 years in Stockholm. I have a fairly long background before other advisory firms like Colliers International and the Newsec. And before that, I worked with property investments, and before that, as an investment banker in London.
My name is Nicole. I work as a research analyst at Savills Investment Management, which is basically the investment management business of the Savills Group. Savills Investment Management is an international player. We have offices worldwide. We have one in Stockholm and in Copenhagen. And I've been with Savills for the past 2.5 years. Within the research team, we are all based in different offices across Europe to make sure that we cover our local markets as well as the pan-European level. And before I joined Savills I worked within the macro research team at Swedbank.
My name is Irányi. I work with Union Investment Real Estate based in Hamburg. We are currently Germany's largest provider of open-end fund solutions, both for private and institutional investors, with assets under management globally of some 40 billion currently. We are headquartered in Hamburg, with international offices in Manhattan, Singapore, Paris, Madrid, and Brussels. I've been with Union Investment for 13 years. Before I joined Union Investment, I was at university. And I am heading our European cross-border team, which takes care of office transactions in all European markets that are non-German speaking. So Germany, Austria, Switzerland is handled by a separate team, and the rest of Europe is handled within my team.
Great, thank you.
Thank you. I'd like to start with could we back a few slides back to Fredrik's outlooks?
Now you're really testing me.
This one, yes.
That one, yeah.
I mean, the European real estate market, the Nordic real estate market has been, since 2008, it's been going upwards, and it seems to be still heading upwards. Do you share Fredrik's picture, or do you have any alternative scenarios? To start with Nils.
Well, there's no doubt that the market is still very strong across the board. We are only active in 3 countries. We're looking at new countries, but we don't see any very cheap relative value anywhere in Europe right now. So it is definitely expensive. I think it will continue to be quite expensive, especially given that interest rates are set to be quite low for the foreseeable future, and that's going to put, in certain segments, I think logistics and a couple other segments, our segment, I think we'll see a little bit further pressure on yield standards. Not much, but a little.
Olle, you must share his picture.
No, I completely disagree with Fredrik. I'm kidding. No, I mean it's hard to have a different view as the main scenario. I think. I mean everything points towards that the market is going to continue to be strong. There's no doubt. And I mean, you see, going back maybe a year, a couple of years, there were you could still hear some people talking about increasing interest rates and so on. I think almost now that you listen to macroeconomists, almost everyone seems to be agreeing that interest rates are going to remain low for the foreseeable future. Mainly also because it doesn't only have to do with monetary policy, but also long-term demographic shifts that doesn't really easily go away. yeah, it's. I think we need to see some big external shock, really, and looking at historically, if you had a downturn in the stock market, that usually hit the real estate market short term. You could really tell the difference in transaction, working with transaction on an everyday basis. We did have a big downturn during the fall, and I'd say it didn't do anything to the property market, so very solid.
How would you define a massive external shock? We have Trump, we have Brexit, North Korea. I mean,
yeah, I don't know. You know, black swan type of things that you can't really predict.
Nicole?
Yeah, I mean, I think we are seeing a global economic slowdown, but there is also a difference to a slowdown and the economy falling down a cliff, basically, which I don't think. But like you highlight, Sverrir, there are definitely clouds on the horizon, and mostly relating to geopolitical tensions. And what I think is interesting looking back at the end of last year is that, like you said, we saw stock market decline. But what was interesting there was that immediately central banks around the world made a U-turn, and they loosened their monetary policy views again, which I think really stop. If you look at equity indices, you can really see it goes down and then it goes immediately up again after the Federal Reserve communicated that they will see a more dovish monetary policy going forward. And I think that is an interesting and very important factor for the real estate market, because I think that is what will prolong this cycle even more. So if we can still get this monetary policy support going forward, I think that this cycle has more to give. And that is something that influences the Nordic markets very much, definitely. And I think that's one of the reasons why we never saw further impact on the real estate sentiment either.
Do you think it's positive that central banks use a more ad hoc approach to monetary policy than they've ever done before?
I don't think positive is the right word. Definitely not. I think this is very much an experiment, and I think what happened at the end of the year with the so-called U-turn in monetary policy is that it very clearly showed how difficult it would be for central banks to navigate out of these loose monetary policy conditions. It really showed that when we saw trade tensions and the like starting to impact stock markets and sentiment, the US Federal Reserve weren't able to maintain the stance that they had, that they would like to tighten, and they had to turn. So I think that is really a scenario that highlighted how difficult it will be to get out of this, if ever.
I think we can return to central banking a bit later on. Olle,
Yeah, sure. So I have to agree, I have to say that I fully agree with your presentation. It could have been a Union Investment internal paper. I will bring it back to Hamburg. No, it fully reflects our analysis, and I agree with what you have said in the beginning. All the European markets are expensive. There are no cheap markets around. Therefore, especially if you are a core investor like we are, it's all about rental growth, and this is basically what's driving the yields. I'm actually, or we as a house, we are currently happy that we are seeing yields not further declining, which we think is a positive. The yields are already at a low level. Only rental growth can support those yields. And in terms of the cycle ending, black swan events and so on and so forth, I mean, we as a house and the entire business community has been discussing this potential downturn for almost 4 years now. And whenever you're going to Expo Real or to MIPIM, it's like, yeah, but now the cycle will end, and now something's going to happen, and actually nothing happened. What I think is interesting, and what is, I don't want to say it's worrying, but it's something that we need to fully understand, is that in the past couple of years we've seen some interesting happenings around the world, whether it was the presidential elections in the United States, where the whole world was in shock for 5 minutes and then everything got back to normal. Then there is something called Brexit, you might have heard of it, which has been dragging on for 2.5 years now. Impact on the real estate market has been relatively limited, albeit supported by capital from Asia, who bet on the cheap currency. So also the increase in right-wing political parties across Europe, it's all things that in other circumstances, I would say, would be viewed as being more worrying, but somehow people are just so focused on placing their monies that those events are digested in a relatively easy manner. I'm not saying this is right or wrong, I'm just saying that this is an interesting observation.
Yeah, this partly a comment on that, partly to answer your question, what a big external shock is. I think we sort of got the answer. The things we have seen have been more cause for worry rather than actual shocks. That's what I would say is the difference. I mean, you said North Korea, well, if they nuke someone, that would be a shock. I mean, just, rattling their arms, that's not really a shock, that's just cause for worry. So, maybe Trump's trade war, I mean, that could be, if it escalates, but so far, hasn't had that much of an impact, but maybe it will if it escalates. That could be something.
Just because it's always fun to disagree a bit, so I thought I'll disagree with one thing you said and get the discussion going. The debt market, I agree the debt market now is very strong. It's super strong, we have very low interest. Personally, I believe from a Nordic perspective, it's going to become more difficult over the short to medium term. I think that there are many companies who have went into the bond market sort of high, or the high yield bonds in 15, 16, 17, and some of those are maturing this year, but especially next year. And I think many of these, even though these are small companies, are going to have difficulty refinancing. I don't see a structural problem, but I do think there will be problems on that front. And I just look at the banks; they're also not super. Nordic banks used to be super stable. It's been like a soap opera the last couple of years. I think it's going to be difficult for them as well to continue to fund this growth. So I think there are more clouds on the debt side. You might not see them right now, but I think they're around the corner.
And what's the difference now than going back maybe 5 or 6 years ago? Because back then there was a lot of talk about the wall of financing that was, coming up, and everyone would have so much trouble refinancing, and then things just got quiet.
I think it stems back to, and this is maybe a separate point that affects it. I think in Sweden, I think we have way too many property companies. It's too much of a fragmented market. And most of these don't have the critical mass or size to be recurrent issuers on the bond market, for example. So they come out once and they don't come back, which they should do. So as long as we have a super fragmented real estate market in Sweden, you will see specific issuers who will have problems. I don't think it's a systematic problem, but I do think there will be some problems for certain companies, and I think that poses some interesting opportunities perhaps.
You at times and a handful of other Swedish companies have entered the Eurobond market. And I think it was in Dagens Industri last week, I think 100 billion Swedish krona, 10 billion euros. Yeah. And if you relate that to the SEK being cheap, which is also an additional question, is it fundamentally weak, or is it just?
I don't know, I'm not a foreign currency expert. I think it will continue to be weak for some time being. I don't see anything changing that short term. On your remark on there are a lot of Swedish issuers, that's partly related to the question, have gone to the Euro market. I mean, Euro bond market. We own assets in euros, so we have a natural need for it. So we borrow to match our assets. But there are a lot of companies who only hold SEK assets who are in the Euro bond market, and they need to swap that into Swedish krona. That's quite expensive. So they're not doing it if it's really that much more cheaper. They're just doing it to diversify. And I see some of those issues are one-off issues, and it won't be recurring. And then they need to refinance it in the Swedish bond market most likely. And I think that could pose some problems. I don't think that's we haven't seen. There are no problems right now, but in short to medium term, I think we'll see some problems there. It's I saw an interesting statistic last week that if you look at the Eurobond issues in the real estate segment in Europe, we're talking Eurobond, the biggest single issuer country is Sweden, with 19% of all issues this year. And Sweden is not even a Euro country. So bigger than France, bigger than Germany, which is amazing. And that tells you something. So I think there's a little bit of a, personally I think there's a bit of an inflation on Swedish issuers going to the Euro.
Is there anyone else who has for instance, you Adam, you also trade in euro. That's your working currency. Do you think the Swedish market is cheap in relative terms, or I mean everything is cheap when you have money, isn't it?
Yeah, well, for us as a house, unfortunately, it's not cheap, simply because of the fact that we always have to 100% hedge our equity positions. So we cannot, in any market, really benefit from cheap currencies. So that's unfortunately a game that we cannot play. And obviously, as shown in the presentation on the yield, it's definitely not cheap. No.
You have invested quite heavily, is perhaps an overstatement, but you have invested in Sweden and in Finland as well, haven't you?
Yes.
Are you in Denmark and Norway as well?
No, we are. So Denmark and Norway are markets that are on our internal country list, so we are monitoring them. Norway, unfortunately, we cannot invest at the moment. We've seen in the presentation the spread in short-term interest rates. And as we need to hedge our currency, as just mentioned, it costs us just too much money because yields are also low. So basically we just can't make our underwriting work. Denmark, we have bought, so our specialized retail team has purchased last year a high street retail asset, which was our entry to the Danish market in Copenhagen. The one thing, we are looking at the market, we're trying to go there twice a year and get an update. What's worrying us is that in some research materials you can read that rents are rising in Denmark or in Copenhagen. I would very politely challenge that statement. I'm not so sure that rents are really rising, and if they are, to me personally, I think this is a short-term effect because there's lots of development going on, lots of land to be built on. This is why at the moment we cannot justify the very strong yields in Copenhagen by rental growth. It's just simply something that we cannot do. However, I would say that if we were able to analyze buildings that are, like state-of-the-art buildings with very, very long-term lease contracts, I would never rule out that we would purchase office assets in Copenhagen.
But in CBD then?
Yes, definitely in CBD. And with regards to Stockholm and Helsinki, which are the main markets we are focusing on in the Nordics, I was just mentioning earlier before the session started that I've actually looked at our statistics in terms of how many deals in which countries did we analyze within my team, and obviously we have markets that are way more liquid than the Nordics markets, be it Paris, you name them. But the interesting part is if we analyze it down to the assets that we really analyzed and put to our first committee, we had the most assets that we analyzed in the Nordics, even more than in Paris, which is quite interesting. So we are currently a big fan of Stockholm and Helsinki. There is a very, very good internal momentum, and what is also helping us in our strategy is that since the beginning of the year, we have set up an in-house, dedicated, specialized value-add team. This is something that people usually would not associate with Union Investment as being a large, conservative core investor from Germany. But we have allocated some €500 million over the next 3 years to invest solely in value-add projects across Europe. And we have so far analyzed most value-add projects, again, in the Nordics, because we think there is an interesting momentum to purchase buildings that need repositioning and that need lease up, simply because, Stockholm basically vacancy in the CBD is zero, it's non-existent. So it's the potential, the downside potential if you're going into a value-add project, if you are able to finalize it within the next 3 years, I think the downside is very limited. Very limited.
Okay. Nicole, I know that Savills have invested recently in Denmark in second-tier cities more than Copenhagen. And,
Exactly.
And I know that you have, Copenhagen is a tough market, isn't it? Because it's very much owned by local pension funds.
Mm-hmm.
But is there any supply in, for instance, high street retail or CBD that you, Savills, can see?
I mean, I think that's what we've discussed before, that the lack of supply is not just a story for the Nordics, but in many countries it's very difficult and prices are very high at the moment. I think relating back to your first question, that we have been looking at Aarhus quite a lot. We also look at other tier 2 cities in Denmark, where we see strong fundamentals, where we see positive demographic development, urbanization, those type of more fundamental factors, which are perhaps not as cyclical. I mean, we have assets in the city center of Copenhagen as well, but we also look beside that for other opportunities. And I mean, I think Aarhus is a very strong region, and I mean, there are fundamentals there that makes it attractive to diversify away from just high street in Copenhagen as well.
Is this something that could become a trend to the entire panel? That second-tier cities are becoming more attractive when the capitals or the bigger cities are like Stockholm, London. It's difficult to find anything.
If I may, I think from a core perspective, I think with that strategy going into secondary markets only because the main markets have become too expensive, I think this is something where you need to be, I don't want to say careful, but you need to be very convinced about the secondary market that you are entering into. To be very transparent, historically, in the last cycle, some of the assets that we bought in secondary markets in Europe have underperformed when the markets adjusted, and I think that whilst they appear to be less volatile than some of the number one markets, I think that they, in a downturn, can suffer higher or can suffer more than the primary markets. What we are also seeing is that the search for yield argument in going to secondary markets is difficult to justify, because the yield spread that in some of the secondary markets you are seeing versus the primary markets is actually not that big. And now also for an organization like Union Investment, which needs to make sure that we can implement a strategy in the cities that we invest in, it's kind of difficult to find follow-up deals. So for an organization with our size, it is challenging to argue to buy one asset of, say, 30 million in a secondary market and not be able to follow up with more deals in that city. So I think one needs to be cautious there. However, the one comment I would make is that we would always look at the, let's say, the best or the continuously outperforming assets in secondary markets, but it needs to be the classical A-B strategy. So A assets in B cities, this is something that we would do, which we have also done in the UK, where I would say that in general secondary markets in the UK appear to be more liquid than in other European markets.
Nicole?
I definitely agree with you. And like you say, going for the very best assets into two cities is definitely important. But I think what is also really important is that you really look at the long-term demand drivers in different regions, where I think some of the more regional cities can actually have better prospects than some of the capitals, or equally good. And I think what we try to do is really to assess this over a long term, so looking at over 10 to 15 years, where do we see the economy going in these specific cities, where do we see the employment growing or people moving into the city, how are the demographics shifting in these specific areas, so really trying to assess in the long term what are the demand fundamentals. And I think that's a strategy where then you can, to some extent, justify not only looking at the capital cities.
But I think it's definitely true, as Adam says, that the yield spread at this point in the cycle isn't huge between
Definitely.
good assets in the regional cities and the bigger cities.
Yeah.
But then again, maybe that's justified too.
Yeah.
So Well,
In the
hard to
numbers,
say. I mean,
yeah.
yeah. But it's also true. You always have to be more careful doing business in a regional city.
Of course.
I mean, it's easier it's easier to make a mistake, really, I would say. I mean, going into an area maybe that's not, all the locals know that it's not a good area, but you don't. You come in, you think you get a good price, and turns out it wasn't such a good price after all. It was a reason.
That's a really good point, really having the local market knowledge, I think, is probably the most important factor.
Yeah.
And also making sure that, I mean, buying an asset in the secondary market is actually not that difficult. You can do the entire analysis, that's fine. You need to analyze the exit. And this is the one thing that is where we are spending a lot of time on analyzing that, because whenever we look at secondary markets, and we are currently not heavily looking at secondary markets, we always look at the investor base. And basically, in some of the markets, you realize that the international investor demand is quite limited. So we as an international investor, I'm not saying that we are right or wrong, but we as an international investor, we go to our committee, and one of the first questions that's always been asked is, okay, which properties are owned by which international landlords? And sometimes it's difficult to find them, or it's limited. And then we are also analyzing, when did they buy? So did they buy only at peak points in the market where they said, okay, the primary markets are too expensive, therefore we are going to the secondary market? Or have they invested in secondary markets over cycles? If this is the case, then we feel comfortable with the exit. If this is not the case, then we are a little bit more careful.
Won't you have a chicken and egg problem then? If you always have to see that there are other international investors already in there in the market?
Yeah, I agree, because sometimes you can benefit from a first mover advantage. I agree, you could say we're the first international investor that goes to the market, but it supports the analysis in terms of liquidity. Because if you can only sell to locals, that's per se not an issue. But in some of the secondary markets, they are dominated by locals, but there are simply not that many in total. So this is something where we just, again, from a core investor perspective, are cautious.
I agree with the fact that there's the spread between prime and secondary yields is too small now, probably. But I'm quite positive to the secondary cities. I mean, first of all, you need to look at which asset class, which segment. Office might be different, but there are many other segments. Residential, in our segment, you're looking at nursing homes, schools. I'm not convinced that buying a nursing home in Stockholm is so much less risky than buying into investor what they're going to do. You need to look at the fundamentals, demographics, population growth, micro-location, all those things. Because you have these segments, residential and a few others, who really don't have rental growth. Our segment, we don't have any rental growth. It's inflation-based. So it's not driven by the same type of supply-demand you have in Stockholm, etc. I personally would be quite afraid to buy CBD office today at a yield of 3%. Rents are, I heard Boston is now developing going out with rents 10,000 kronor per square meter, vacancy which are zero. That you put a low yield, no vacancy, and rents which are second highest in Europe, and there's three parameters which can change. Personally, I'm scared about that, so I prefer to focus on the cash flow and get a better yield somewhere else where I don't have really the rental growth.
But on the other hand, you have Hemsö as an internal investment horizon. I guess it's a different thing.
It's different. I buy some hold, so I will hold for 25 years, so I'm less concerned about liquidity.
Yeah. The point that you just mentioned, I fully agree with, is that you must make sure that you don't buy at the lowest yield based on the highest rent in the building. That's the worst mistake that you can do, because then you have only downside. As far as rental growth is still projected for the next coming years, if you feel comfortable that the passing rent of the asset is below peak or below prime, I think that there is still room for growth. And the one thing that we are also convinced of is that if you're buying good quality assets in very good locations, doesn't necessarily mean that it has to be a CBD per se in Helsinki. It can be a Pasila or whatever. But if you are buying good quality assets in very good and or the best locations, even in a downturn, you will have tenants maybe at different rental levels. I fully agree with you, and there's a risk to that. But in the previous cycle, whenever we as a house went into more secondary locations and primary cities, some of those investments suffered in the downturn because you had long-term vacancy. So for us as a house, and for me personally, it's very much driven by you need to be convinced about the location and make sure that you can because of the location and the amenities, attract talent. What I always
Well, you need to be local. I mean, it's difficult for you as a big international investor to open up an office in Västerås. I mean, probably not happen. So being local and having.
Hi, Fredrik. My question was on rental growth and your view on rental growth. We just heard you don't expect the HemsöFastighets expecting rental growth, but considering the forecast that you have both continued rental growth and the same yield, that sort of implies that the rental growth will stay the same. Because as Irányi mentioned, the low yield is justified by high rental growth. So you expect the rental growth to stay the same or to slow down and then that push up again?
Yeah, well, I think it's a relevant question, and it varies definitely from market to market. With regards to Stockholm, even if you are not reading the materials provided by the known advisors in the market, even if you look at independent research, for example, P&A, they are forecasting 3.6% growth rate for rents per annum for the next 4 years. This is incredibly strong. We think that PMA is very good at their forecast, so we believe in that. We also see strong rental growth in Helsinki, so we expect that to continue also at solid rates. There is no doubt that it can't go on like this forever, but if we are able, and this is the point that I referred to earlier, if we are able to buy an asset at a, say, the market yield, at a strong yield, but the passing rent is not at peak, a little bit below, you catch the growth, and even if it then levels out and you have only flat rental growth, for us we can make our average performance numbers work. And this also refers to other European markets as Amsterdam, Paris. These are markets where basically you bought an asset 1 month ago and it's already under rented. You need to be careful. It starts to feel a little bit hot. I agree. Also, one interesting comparison that I did yesterday when I was reading some research is that actually prime rents in Stockholm now are at the same level as prime rents in the CBD in Paris. It's an interesting comparison. If you compare the amount of population, if you compare the total office stock, the amount of workers in those markets, it feels very strong for Stockholm, to say the least. But to answer your question in short, yes, we believe that some of the markets still offer strong rental growth simply because there is no vacancy and there's nothing to be built. And we also see that tenants are becoming or have become way more selective when it gets to picking locations. They just don't say, oh, CBD is too expensive, I'll just go somewhere because there is a train station. It's about, yes, connectivity, but it has to be the right connectivity. It's about amenities. It's about work, live, play, and this is all that makes locations. And what we have seen, we also looked at some opportunities in Pasila, for example, in Helsinki, where you see that CBD gross rents have now achieved actually something like 40 euros a square meter, which has never been seen in that market. And then you take a train, one stop, not even 4 minutes, and you get a discount of roughly 30%. And you have shopping centers there, amenities, sports facilities. Residential development totally makes sense. You know? And in those locations, we have already seen rental growth since those projects have started.
I just wanted to pick up a couple of some of the trends that we've been seeing, particularly in the events that we've been having over the kind of first half of the year. Capital flows, we haven't really talked about yet. Very interesting, Fredrik, in terms of the presentation, the different percentages of international capital coming in. And you mentioned also Asian investment, which has been a big topic in all of the sessions that we've done. And we had one on Germany just last week in London. And interestingly, on the panel was Boon Chai Lo, who's the CEO of the Singapore Stock Exchange. And he was just saying, how much particularly Singapore-based private investors are particularly looking to access the markets, and so there was an increase in interest in German investors actually listing on the Singapore Stock Exchange to be able to access that capital. But certainly when he was talking about what in general Asian investors were looking at, he was saying, well, it's the UK, it's Germany, it's France, it's Amsterdam essentially, and it's the Nordics, which is quite interesting. Are you seeing more Asian capital beginning to look or coming into either the your shareholding, or what's the sense? Let's start with you, Olle, because you'll be seeing a lot of this capital coming through.
Yeah, I mean, I would say in general, we saw a lot of direct international investors before the financial crisis, so 2005, 2006. And my view is that after the financial crisis, most of the direct international investors disappeared from the market, and they still haven't really come back as direct investors to any large degree. I mean, when you see the graphs on the amount of capital in the transaction, the part of the transaction volume that comes from international investors, it looks quite high, but it's usually just a handful of investments, very large investments, and usually indirect in one way or the other. So it's, I think it's hard to say. I personally don't get a lot of calls sort of from some Singaporean investors or Chinese investors saying, well, we want to place some capital in Sweden in the property. It's more, to me it seems like it's much more indirect route, and that's harder to track, I think. If you talk to a local asset management partner, for example, you usually don't really know exactly where their capital comes from unless it's big names. But I mean, this more anonymous capital, you don't really know. So sort of a blurry answer to the question, I guess. But it's the answer is that we don't get a lot of sort of direct contacts with Asian investors, for example. And I would say, talking to other advisors, usually when they get that question, they start off by saying, oh yeah, but then when you start sort of scratching the surface, the answer turns out to be the same that I just gave you. You know, it's more sort of rumor based where the capital comes from rather than you actually see it face to face. That's my view.
I have to say, I fully agree with regards to the Nordics. When we are analyzing assets and participating in bidding processes, sometimes from the instructed sales agents, we hear rumors like, yeah, there's also Asian capital bidding. We have never been in a direct competition with Asian capital in the Nordics markets. So I agree. To me, it currently feels more like a rumor, or maybe more like a start of that capital trying to flow into those markets, but we have not seen them yet in direct competition. Also, when we're talking to colleagues of ours in the industry who are investment managers who work lots with Asian capital, they are trying to route them into the Nordics, but they are telling us it's still not really happening. Not really, but who knows?
But it's either we're either talking about the really big money, and that always has problems in being invested in the Nordics because the deal sizes tend to be too small. So they say they might go around for 5-10 years saying they're interested, but they're not finding a single deal to do because they need the deal to be $1 billion for them to be interesting. And then you have sort of small, more opportunistic type of capital, which would be maybe private individuals and so on that buy. Because they know someone, they know a Swedish or a Finnish person or something, they start some kind of collaboration. But that's so much on the margin, I would say, when you look at the total deal volume. So you can't say that it's a big trend, really.
Okay, good. And one of the other trends that, again, we've been seeing a lot is a focus on ESG, but also particularly on wellness, well-being, and in terms of trying to make that pay for the bottom line. how are you seeing that? There's always been quite a positive view on sustainability, and interesting to see in Germany as well that the Greens, in terms of the elections going up, which suggests that there's going to be more of a focus on sustainability as well, I think, potentially, coming through from government. What's your view on how some of these kind of, what would have been viewed certainly 2 years ago, but in terms of wellness, maybe even 6 months ago, would have been viewed as a very soft factor? How much do you think those are influencing decisions going forward? Anyone can pick that up.
I think it's very important. I mean, ESG, everybody talks about it on the equity side, on the debt side. The problem is that everybody talks about it, everybody does it. I mean, I don't think you find a single investor not saying it's important. But what is ESG and how do people work with it? I think unfortunately it's all across the board, from almost nothing, but it looks good on paper, to people who investors do a lot. So I think it's getting diluted a bit, the whole ESG message, because most investors aren't actually doing much. But I think it will continue, and I think it will. We see it on so we don't have equity investors. We only have one owner. We see it on the debt side where we have issued sustainable bonds, and there you diversify the investor base. So I think that's, even though the pricing might not show on the pricing, but it definitely means that you can tap into a bigger investment pool. And I think that's probably the same on the equity side. So it does. The more ESG, the more environmentally friendly certificates, whatever you want to call it, the more investors you're able to open up. And I think that will continue to be much stronger. And I think also, I hope, and that also will become much more clear what we mean by ESG. So because now everybody's doing it, and they're not. It's just you get a certificate and you say, oh, look how good we are. But most investors or public owners aren't doing anything.
I would definitely agree with you. It's really difficult to actually see concrete examples of ESG. Like you say, everyone has to have it. But I mean, from our perspective, it's something that we, within our company, we have our guidelines. But of course, it's also something that our investors expect from us. And I think, if you think back to your question about, for example, the Green Party in Germany, I think we may not have seen the effects of that movement in the property sector yet. But I think that's just a matter of time. And I just remember I read this article the other day about the mayor in New York who wanted to ban glass facades because they are energy inefficient. And I think those type of more relating to climate change, I think that whole movement will of course impact the property sector as well, but I don't think that we are seeing the direct effects of that yet.
And it needs to be, I mean, we are this year, we're investing 15 million euros just in solar panels and geothermal energy, just this year. We invested about 15 million euros last year. But we're doing it, yes, because it's sustainable, but we're also doing it because it's very profitable. It's actually the most profitable investment we're doing. We're making an 8-9% return on those investments. So when it becomes feasible from a profitability perspective, investors start doing it more.
Are there any subsidies involved in that profitability?
And on the solar panels, partly, but on the geothermal, no. So yes, a bit of that is driven by subsidies, but most of it is not. So it can be very profitable, and as technology advances, and I think I believe a lot in green technology there that we can make it profitable to these investments. You continue doing that. But there's one thing which I think on the ESG, which I think is important. Everybody talks about green and the certificates, this and that. But the problem is that developing real estate is one of the worst things you can do, because it consumes so much energy, cement, all that. One thing we're missing completely, I think, in today's debate is that I have a colleague, he always says that the most environment friendly you can do is not to build a building. Use the buildings you have in a much more efficient way. That's much better than getting a LEED Platinum certificate on a new build. And that we have lots of buildings, especially in our segment, schools, especially, and many other within office and residential, we're not being used enough. I think we need to take care and use the buildings we have in a much more efficient way. And I think that trend will become much clearer. I hope so.
But the general wisdom there, I've looked at those sort of types of deals many times, and the general wisdom seems to be that, well, when you start crunching the numbers, you end up with the fact that it's more cost effective to tear the old building down and build a new one.
No, but I'm thinking of buildings which are schools, for example.
Yeah.
Very niche perhaps, but it's a good example. Schools are closed for 50% of the time. Summer, Christmas, Easter, weekends, evenings, not being used. You can use those buildings for other things during those times. Why? Why don't they do it? Because it's work. How do I book, and who manages it, who pays for it, and these are. I mean, you can solve that. They're just people are too lazy. I think that we can do much better.
Then you have to re-tax the building.
Yeah, taxing, how to do VAT, etc. These are, that's nitty-gritty, but that's the reason it's not being done more.
But I think with regards to the question that there's more value, so financial value in investing in green and certificates, what we have seen is that there were some years where it was very much en vogue to buy buildings with sustainability certificates. I'm convinced that in the beginning some investors even didn't really know what that meant. It was just, okay, we bought a building that has a certificate. There was also a trend when especially large corporate occupiers demanded buildings only with certificates. And we are seeing that it is still very important, this whole subject, but did we do better deals or did we achieve higher rents because of certificates? I think rather not. And I think that what we are now seeing, especially with the growth in the startup sector and in the tech sector in many of the European hotspots, those tenants are rather interested in themes like community, well-being, and so on and so forth, rather than having just a certificate on their building. So we still continue to try to buy buildings with sustainability certificates. We are also buying buildings that do not have sustainability certificates, but then we try to get like a real use certificate because we think it helps. But I agree with your point that you just need to make sure that the buildings are used in a smarter way rather than just putting a label on the facade.
I'm aware that we've now got about 15 minutes left and we haven't really tackled the sectors. So why don't we pick up on the sectors? Obviously you're focused mainly on office, Adam. So just give us your view particularly on that, some of the trends, because there's obviously co-working has been a massive thing in London but also across other areas in Europe. How do you see that within the investment context? And also maybe just as well, just give a sort of short view on some of the other sectors, the house view from Union on retail, which has taken a bit of a bashing here in the presentation. Just give us let's start with office and then just give me an insight on some of the other strategies.
Sure. So in terms of offices, I think I already said what our views are in terms of rental growth. So I think that's really clear. With regards to the co-working shared office phenomenon, it's definitely a big theme across Europe. That is clear. Obviously, the entire industry likes to only speak about WeWork simply because they are the largest, and I think what they have built in terms of company brand is incredible and uncomparable. But we have just in the beginning of this year bought an asset in Paris with one of the large co-working providers, and we did the analysis on the covenant. I think on some of the companies it's difficult to analyze the quality because either they are brand new or they are still in a growth phase, which they have done for a very long time, but still they're not really working profitable. So I think we would always analyze assets, even if they are single let to shared office providers, but always with the bottom line analysis whether we A, believe in the building if it was not let to the tenant, and B, if we are convinced that we can lease that building in a worst case scenario to the open market. So that would be our view on the shared office space. With regards to other sectors, I mean retail, I think what we are observing is something that the entire industry is observing. High street retail is in general still performing pretty well. I think that there is a separation now going on with regards to shopping centers. You have relevant, dominant shopping centers that are still performing extremely well in their, and they have a right in its own where they are located. I think other shopping centers are suffering. But again, I think that's not new, and maybe just briefly touching upon hotels. We have a specialized dedicated hotel team. We even have a specialized hotel fund. We buy business hotels. We are not in the luxury hotel segment, and we are also big believers in business budget hotels. We own some 12 or 13 Motel Ones. I think they're not around in Scandinavia, if I'm not mistaken. Motel One is also, it doesn't always ring a bell to some of the market participants, but they are quite dominant in Germany, in the Netherlands, and Belgium. They have also opened in London, and it's a relatively cheap alternative, but it offers everything that you need for say 1 to 3 day business day. So it has functioning and perfect Wi-Fi. I mean, still even in some of the big 5-star hotels, it's difficult to log on the Wi-Fi, which is, I think, incredible. It has a bed. It is clean. It is very efficient, and it simply doesn't have, like, you know, a wellness area or something. But and we like to stay in our own hotels in the markets when we are traveling there, because it offers everything that you need for a short-term trip, not for a holiday vacation.
And if anybody ever wants to go to Pravada, which is the sort of business arena of Holland, I was there a lot. In fact, the Motel One is the nearest hotel to Pravada, and it's not on any of the hotel sites. So it's a very sneaky one to be able to get. Very well on that.
Lots of rooms available there.
Nicole, you've obviously got Savills has got a investment management has got a positive view on against the rest of the market to a certain extent on retail. Does that fit also here for the Nordic market?
Yes, I would say it does. I mean, we have, I would say, a bit of a contrarian view to many other managers on the retail sector. And that relates to, we definitely acknowledge these large structural changes that the sector is undergoing, which are partly relating to e-commerce, but I don't think that's the full story. It also has a lot to do about demographic shifts, urbanization trends, and the like. And what we are seeing is basically there is a consolidation going on in the market. There's clearly a polarization where the stronger regions and the stronger performing assets are definitely doing well at the expense of others. And I think the trend of the polarization will keep on going, where, let's say, the stronger will get stronger and the weaker will get weaker. So what's it about now, I think, is cherry picking. So if you have a local market knowledge, which we do in the Nordics, we still very much see that there are opportunities within the retail segment, but those are very asset specific. You really need to know which market you want to go into, which type of retail segment. It differs a lot between different segments, but we do see cherry picking opportunities there. And just looking at the wider trends, which is not only a Nordic phenomena, you can clearly see, for example, the discount sector is growing massively across Europe, which is now also a trend in the Nordics. Which, when you look at the factors behind that trend, it's interesting to see that what is doing well is actually the luxury segment or the very niche type of retails, but also the discount attracting the broader mass. And what we are seeing really is being squeezed is this middle segment, which is also the segment that is mostly doing well online, because discount it's too cheap for it to be worth to ship, and the luxury segment you get the whole experience, but also convenience, experience. There are opportunities within the retail sector if you know where to look.
Okay, good. And Nils, one of the things that's been coming up a lot very recently is also sort of cradle to grave strategies, as they've been called in the UK anyway, which runs from nurseries through student housing, through healthcare, through senior living. Are you benefiting from more of a focus on that sort of niche, those what would be called niche sectors anyway?
Well, definitely. It's definitely a growing segment. So, although they're very different, you compare a kindergarten to a hospital to senior living to, they're very different segments. People tend to put them in one segment, but they're quite different. But I believe a lot in that, and I believe also in specialization. You need to be good at these things. Managing a student housing or a school is very different from an office. It's completely different fundamentals in managing and owning and building that. So you need to be specialized. But we're seeing Sweden and Nordics started quite early, especially Sweden, when it came to this. So this has been around now for the last 10 years. But in many other countries, and I think Germany is an example. Nursing homes, which we own about 50 nursing homes in Germany, and 3 years ago, almost there were very few buyers, and we've seen yields come down 150 basis points in 2 years. Lots of new investors come into that market, but that's only the nursing home market. We still see the other segments you mentioned, nurseries and the hospital setup, which are still not being touched by many investors. But I think it's a trend that will continue, and these asset classes will be established, just as established as logistics and office and retail. Now they're put into one bucket. They're quite different, I think, but they will be established as asset classes.
Okay, good. And well, just in terms of picking up on the residential side, it's interesting that although they're not doing it here, that Union Investment have moved into sort of micro-living in Germany, which is not something that would have been expected a while ago. Adam, I would say kind of 5 years ago, it wouldn't have been a strategy for Union Investment, I think.
Yeah.
What's happening here in the market? I suppose where are the opportunities in that residential side, given that you've got urbanisation, growth in urbanisation, but also an ageing population here?
It was interesting to talk before to Adam about the definition of micro-living, because it really spanned, I would say, in Sweden, different segments. Because you talked about yuppies, young urban professionals, for example, that was one target group for micro-living, and whereas students was another. And I'd say in Sweden those would be considered to be completely different segments. You would have student housing as one segment, and the other part that you talked about would be more sort of corporate living, I guess corporate residential, I think we would call it, that you would sort of, which is a big difference here since the rental market for residential is quite heavily regulated in Sweden, and is not regulated if you let to a corporation. So it's a completely different sort of type of investment, and I think also to manage. Well, we've seen a bit of student housing going back 5 or 6 years was considered to be kind of the B investments, I would say, of residential. People used to wrinkle their noses a bit when you came with a student housing product. They would say, "Oh, it's more expensive to manage, and students just break everything, so it's harder to sort of to get a grip on the cost of managing the property." So, but that's changed partly, I think, because all the talk about housing shortage in Sweden, and I think it's particularly for young people and particularly for students. So that's changed. So now there's a few players who don't want to do residential in general, but only want to do student housing. That's a trend maybe going back 2 or 3 years, which is quite interesting, I think.
I mean, certainly the trend that we're seeing in terms of specialisation and audiences for that, we did a session in London about 3 weeks ago, which I thought was very niche, which was CEE student housing. But actually we had to change the size of the venue 3 times. Just because of the level of interest of that, which was more than in either European student housing or a session on CEE. So that short kind of focus really attracted a huge amount of interest, which is just interesting to see, I think. We haven't touched on logistics, which I'll make as the sort of last sector that we look at. Nicole, what's your sense of that? Obviously, the UK very far ahead in terms of e-commerce, driving logistics. You've got other trends across Europe. But what's the situation here in the Nordics? Do you, I guess, agree with the sort of sense of where yields and rents are potentially going?
Yeah, I would agree with that. And I think like you say, the European trend of really growing demand for logistics is definitely apparent in the Nordics. And I think going forward, looking at the more mega trends of it, I think what we will see more of is probably more of these mixed-use facilities, potentially multi-story logistics. I think there will be a huge demand for these more urban facilities to manage the last mile, which I think is one of the main problems in the supply chain currently. So yeah, we're positive on logistics, and I think particularly the light industrial segment surrounding the larger cities looks very interesting.
And do you think, it's one of the issues when you're looking at cities like Stockholm, like Frankfurt, like Munich, where actually zoning, those kinds of things make it quite difficult to bring that last mile logistics and that mixed use into the middle of town. Is that a practical solution here, do you think?
A practical solution?
In the sense that, will you be able to get that through planning? Will it get permission to be built?
I think that's difficult to say, very much a case by case. Looking at the municipalities in Sweden, but I think to be able to support the last mile facilities, I think that's where you have to go because it's so expensive close to the cities.
You want to pick up that?
Yeah, I want to pick up a bit on it because it's one of our major focus sectors. So I want to say a few words about it. But I think it's a segment where just as Nils was saying, in social infrastructure, you tend to put everything in a bucket. It's a bit the same in this because we usually label it logistics. But we really mean logistics and light industrial, and light industrial have sort of historically not been considered to be that interesting, so it's kind of a tag along on logistics. But to be honest, I think they're hugely different. Both in terms of tenant structure, where they're located, the underlying dynamics. Everything is very different. So they really merit from being separated, I think. And if you look at logistics in terms of the market sentiment, that's been a hot sector for a number of years with yield compression. Light industrial, on the other hand, that's a newer trend. That's sort of the latest rage, I would say, in the Swedish market. It's gone from being just a handful of players who invested that to a number of new ones, and both established who have recently not looked at this particular segment to completely new players, so it's quite interesting.
And is that only because they're looking at a difference between the yield for light industrial and the yield for logistics, and they're thinking these are then potential logistics areas?
Yeah, absolutely. And also, for 30 years, there was basically no rental growth in the light industrial segment at all. And then all of a sudden, the trends that we talk about here have become apparent. And it's become apparent that you can actually get rental growth if you have the right type of building and so on, benefiting from e-commerce and so on. So we've seen the huge rental growth. It took some time for the market to pick up on that, but now they've started to. So that's some players just want to go in and buy stuff that they experience as cheap, but a lot of the new interest really stems from the fact that they believe in rental growth, just as Union does with offices. So, but I also wanted to comment on the zoning issue, because that's going to be a huge problem. A huge problem. Just looking at the developments in the Stockholm area, the municipalities don't take this type of buildings, this type of properties into consideration at all. They pushed everything just way outside of the city, which isn't practical for a lot of businesses who need these kind of premises. So that's going to smack us hard in the head over the next 5 to 10 years, I think.
Yeah. For those who will be reading about this and watching it around the world, we should just give a view on where you see the best investment opportunities in the current market. So let's start with you, Nils. Where do you think the best opportunities are at the moment in the Nordic market?
My favorite is still Finland. even though it's become more expensive last year, I still think Finland provides pretty good investment opportunities. And as we only deal in my segment, I would say especially in the school segment.
Okay, good, thank you. Olle.
Well, I still think, even though we've seen an almost unprecedented yield compression in the light industrial segment, I think there's still a lot of good deals to be done there.
Okay, great.
And actually also soon it will be time to look a bit outside the big cities as well and look at the regional cities.
Okay, Nicole?
Yeah, I agree with you. Light industrial is definitely an interesting segment at the moment, but also these larger distribution centers in the main transport corridors. I think I've already said our view on retail. We see the opportunity for cherry picking in certain segments within retail. And regarding offices, I would say that we still like CBD, fringe of CBD, but also the best suburban locations in the capital cities.
Okay, good. Adam?
Yeah, obviously I'm going to say that buying offices in CBD locations is a very good thing to do going forward. What are the best deals to be done? I think you can probably make the most profit if you're buying into the rental hotspots and you're buying buildings that need restructuring and repositioning.
Right, thank you.